We dismiss history at our peril.
Liberty Nation Radio with Mark Angelides.
From general poo-pooing to outright denying such a thing is possible, it seems that the R word, recession, has once again reared its ugly head. Now, what does this mean for markets and the average family? What are the indicators, and how deep will it likely go? Well, we're back with Andrew Rand to answer these questions and hopefully a few more. Andrew, I thought talk of recession was in the rearview mirror, that it was all just vertigo, and any other Hitchcock reference you care to make.
Yeah, heading into 2023, recession talk had died down, but then a couple of things happened on the way to the dreaded R word. One was that the collapse of Silicon Valley Bank and Signature Bank, and then a lot of the data heading actually into SVB. So you look at some of the February numbers like construction spending and factory orders, that's actually declined. And this all happens before the banking crisis. So really, you have to monitor what happens over the next few weeks and a couple of months based on the data front and how the economy responds to the banking turmoil.
So I remember last year we had literally everybody in the fourth estate, most people, I should say, not everybody, but many of the fourth estate outlets were poo-pooing the idea that a recession was even possible, even though the technical factors had been met. They pointed to, as we've talked about in the earlier segment here, the jobs numbers and how that mitigates what would otherwise create a technical recession. What are they saying now?
Well, now, I mean, in the aftermath of SVB and Signature, most economists have raised their recession odds. I mean, you look at even Goldman Sachs, which I call it a perma bull, it raised its recession odds from 25 to 35%. And you look at some of the numbers too, the Atlanta Fed Bank GDP Now model estimate, which is a pretty reliable measurement. It lowered its estimate to 1.5% for the first quarter. And overall for the rest of the year, I mean, look at the IMF's recent GDP outlook, and has about 1.6%. So even if you don't have a recession, you're still going to have inevitably a stagflation environment, which again is a talk of the town once again. Mohamed El-Erian, he's been talking about that, and you have lackluster economic growth with still elevated inflation. So either it's recession or stagflation. Pick your poison.
It sounds almost like Shakespearean, doesn't it? It's a recession by any other name would smell as sweet, but you're just changing. It's a recessionary factors without the technical recession.
And also, if you can look at some sectors of the economy too. So I mentioned in our previous segment about manufacturing. Manufacturing is in a recession itself. Many of the leading indicators in this industry has been weakening, whether it's labor, whether it's output, new orders, whatever the case. So and then the banking sector, that could inevitably also be in a recession based on the inevitable credit crunch that's been or the data showing a credit crunch anyway. So yeah, so maybe not a national recession. Maybe I think actually they call it. There was actually a rolling recession, I think it was, whereby maybe not the entire United States economy, but various pockets of the marketplace would be in a recession. I think I wrote about that for Liberty Nation a couple of months ago.
Now, the Bank of America, they released a series of charts. Now, basically the idea of those charts was a series of key indicators that tell us that a recession is either here or on its way. What do they tell us overall?
Well, essentially that a recession is coming. I mean, one of the key recession indicator that most investors monitor, and the other complementary measurement that the Fed monitors, is the inverted yield curve. So in those PMI charts in the Bank of America chart you shared with me, one of them was a 2-year, 10-year Treasury yield curve inversion. So that was from the last time, it's negative 62 basis points. And then if you look at the Fed's preferred, which is the 3-month, 10-year yield curve inversion, it's about 167 basis points last time I checked. But there was one of those charts that I disagreed with. One was at the manufacturing PMI. Now, yes, it's absolutely correct that the manufacturing PMI has been slowing down in contraction territory for a while. The problem is that manufacturing now only accounts for 11% of GDP. Now, can that lead the country into recession? I don't exactly concede. I don't exactly know that, but we overemphasize manufacturing. I mean, yeah, you can argue whether U.S. still needs manufacturing or not, but if the manufacturing is a key indicator of the slowing economy, I can't agree with that assessment. But overall, those charts from Bank of America are accurate. I see those charts all the time. I see the data numbers frequently, and yeah, they're accurate. So yeah, that's a recession. Its forecast of recession is accurate.
So, Andrew, do you think that now that pretty much everybody's agreed that the recession's there on the horizon, we're fast approaching it, do you think that the de-dollarization campaign that's been taking place around the world, all these different countries doing their contracts in other currencies, do you think that's going to add to the issue?
No, not at all. The de-dollarization campaign, and I've been asked about this frequently on radio and television, is that this is a long-term problem that's going to cause a lot of headaches for the United States economy. So I'll leave people like Dave Patterson, our national security correspondent, talk about the geopolitical consequences of de-dollarization. But from an economic standpoint, the long-term consequences are severe. I mean, let's go to a timeline, for example, here. So in 1922 or 1928, excuse me, the U.S. pretty much displaced the pound sterling as a chief international reserve currency. By 1944, the U.S. dollar had become the chief international reserve currency. It exacerbated after Nixon got off the gold standard in 1971. Since then, the U.S. has exported so many dollars throughout the global financial system. Many countries have in their forex reserves, they have it in their bank accounts, all that stuff. The problem is that the U.S. has been able to export its inflation for that long. If these countries decide that, okay, fine, we don't want to deal with dollars anymore, we don't need as many dollars anymore, we want to deal with won and rubles and reals, that, okay, we can ship back now the U.S. dollars into the United States economy. That would create an inflationary headache just because of the fact that the U.S. currently has about $21 trillion of currency in circulation. Let's say the foreign debt is about $12 trillion. That money goes back into the U.S. economy. You have hyperinflation. And it's not just me saying that. I mean, there's a great economist, E.J. Antoni. He wrote for Heritage, and he talked about that exact same thing. Is the U.S. has been able to export inflation for the last couple of decades, and the de-dollarization is that thing that's going to destroy the U.S. dollar. That's going to be end the dollar hegemony. And then you have what goes in its place. You have perhaps the won. You have a basket of BRICS currencies. So there are many options to go out. Some people say a gold-backed currency, but that I can't. It'd be nice, but I don't see that happening ever. A gold-backed currency.
So simply, I think what you're saying here, Andrew, is that we've got either super inflation or recession. Pick your poison.
Well, as I talked about over the last 12 months, is that the recession will kill inflation because the whole Fed, what the Fed has been doing is to kill demand, and it's been killing demand. I mean, you see a lot of the numbers, you see a lot of consumption levels have been tapering off. So yeah, the recession would kill the inflation. But I mean, you're trying to conflate the two issues, whereby the de-dollarization is either going to ignite the recession or inflation. But long term is the inflation problem. And I think I mentioned this on your show a few weeks ago, talking about, I think the more plausible scenario is you have a situation in the 1980s and 1990s where it looked like Paul Volcker, the Fed chair at the time, vanquished inflation by 1986, but then it started rearing its ugly head again, and then you had a situation of ebb and flow inflation. And then it wasn't until about the mid 90s that inflation was around the Fed's 2% target rate.
Inflation Back to the Future edition. Andrew Moran, thanks ever so much. We dismiss history at our peril.
Liberty Nation Radio with Mark Angelides. Entertaining, informative, and just plain fun. Watch Liberty Nation's The Conservative Five. Produced by conservatives for conservatives. C5's The Left Free Zone. Hosted by Liberty Nation's Lisa K. Donner. Joined by a raucous, irreverent panel of authors. Deconstructing leftist narratives. Debating the hot topics. And remembering to laugh. Join the official conservative safe space.
You only did that to piss Jeff off.
Liberty Nation's The Conservative Five.